Andy, welcome. What's your take on the latest round of data here?
Yeah, I mean, I think you covered it really well there. I mean, we absolutely saw some demand return to the market early this year when we saw rates get down closer to 6%. Very welcome news for lenders and transactional-based folks out there in the market. And it did show that underlying demand that still sits there if and when rates come down. But at the same time, sellers are backing away from the market. And so we still have these massive inventory deficits out there, and that's resulting in price hardening this spring.
What's going to happen in kind of the spring selling season? Then it originally looked like we could be off to a good start, an early start. And what now?
Yeah, I mean, you're right? So we saw demand return early, the later months in February. So we went from a 30% deficit down to a 15% deficit. We're back to a 25% deficit in terms of demand. I think what we'll see is a modest rise in transaction volumes. We're already seeing that in our collateral analytics data for the month of February. And so we're probably nearing the bottom there in terms of just overall sales volume and purchase origination volumes out there in the market. But it's going to be a slow and kind of bumpy return to normalcy. And unfortunately, I mean, for folks wanting to see prices remain high, the data is good for them right now. You're seeing kind of this stalemate out there in the market, not a return to balance, but we're not seeing anybody budge here. So low transaction volumes, hardening home prices is kind of how we see this playing out over the next few months.
It's almost like the Bitcoinization of the housing market. You know, there's only 21 million that we're ever going to have, and everyone went and snapped one up, and everyone's just holding on to them. I mean, I don't know how you get more image. So in a market where if we go back to '06. When prices started to drop, we overbuilt, we saw people then immediately back away. What's it going to take to get prices to turn in this market?
Yeah, and what's noticeably different about '06 through 2012 was the Fed dropped interest rates to try to catch the market there. And so you didn't see this lock-in effect that we're seeing take place now.
True.
The other thing that took place there was we had this massive wave of default activity. We had 25% of homes were mortgaged with adjustable rate loans. So they were much more volatile, and you had interest rate sensitivity, and folks were willing to sell because their rates were resetting anyway. We're running at some of the lowest levels of outstanding ARM loans we've seen in the U.S. in over 20 years. And so default activity remains extremely low. Foreclosure sales, 70% below pre-pandemic levels. New builds are very low. Existing home sellers are selling their homes at a 27% lower rate in February than they traditionally do. So every potential possibility that we have for increased supply is running well below normal levels, and there's no line of sight into how that returns. The demand side there absolutely is, right? And we're seeing that in terms of when rates fall, you're seeing that demand return. But that same lever that's pushing on demand is also holding supply tight, and there's less of a line of sight in terms of how that supply side returns.
You did just give me one idea about how this, when this will all play out, which is to say when the 10-year starts dropping. So in other words, if you look at the market now, we have people pricing in pretty extreme rate cuts kind of next year. It's like the more hawkish Powell gets, the more the near term goes up and the long term rates decline. If we get into a situation next year, Andy, where all of a sudden the 10 years down 1.5 points, we're back at 2.5%, and people feel like, oh, I can move because now my new mortgage will be affordable, and I'm going to list my house now because I'm worried that prices will fall more, then I wonder if we wait a year or so out, if it's going to be a very different story.
It could be, right? And what you tend to see is the 30-year tries to project where the 10-year and where the Fed is going. And so in past rate cycles, 30-year rates peak 0 to 3 months before the 10-year before the Fed does. And so we could see, absolutely to your point, you could see 30-year rates and mortgage rates start to ease before the Fed starts to let off the brakes. Though the question is, will that move the needle for sellers? It absolutely has, and you can track demand right along with interest rates. But even when interest rates eased in January, early February, we didn't see a return of sellers to the market. And that's really where my concern is it hasn't ebbed and flowed directly with interest rates. And so there's no guarantee that sellers are willing to sell at a 5.5% or a 5% interest rate.
Oh, sure.
We'll have to see how that plays out.